Hey there, and welcome back to The Explainer. I'm absolutely thrilled to have you here today. We are doing what we do best, taking some seriously complex financial maneuvers, breaking them down, and figuring out what they actually mean. Today's entire framework is all about reading between the lines. We're going to hunt for the real signals, cutting straight through all the corporate noise and a fresh batch of filings. Because, when you watch how a company throws its cash around, or exactly who they're putting in the C-suite, you are getting an unfiltered look at their true strategy. So buckle up. We are unpacking three massive events that just dropped in the fintech space.
Okay, let's dive into this. On our agenda today, we've got three incredibly high-stakes case studies: Tiger Broker's expensive pivot, Shopify's $3 billion bet, and Nubank stealing Visa's talent. It's the quarter where the bill finally came due, the buyback got way bigger, and the best CFO in the room switched jerseys. So let's get right to it with our first story, Tiger Broker's expensive pivot. This whole situation is a complete masterclass in contradiction. To really get this, you have to look at the sheer velocity of their growth. Just look at these Q1 metrics for a second. Total revenue, bam, $154.9 million. That is a 26.3% jump year over year. Their funded accounts reached 1.28 million, which is up over 11%. They added almost 29,000 new clients in a single quarter, mostly pulling from Singapore and Hong Kong. And client assets surged 28.4% to almost $59 billion. Honestly, by literally every operational metric you could check, this is a business that is just executing flawlessly. But here is where we get the ultimate narrative record scratch. Right in the middle of all this winning, Beijing drops an invoice on their desk for roughly $60 million. Let's look at exactly how that happened. So China's securities regulator slapped Tiger Broker's subsidiaries with administrative penalties, hitting about 411 million RMB. That converts to that massive $59.7 million figure. The charge? Running an unlicensed cross-border securities business, plus illegal fund and futures operations on the mainland. Think of it like a basketball game where a player sets an illegal pick. The ref saw it, they blew the whistle, and the points instantly come off the board. This one massive fine completely flipped a highly profitable quarter into a $26.9 million net loss. To put that in perspective, in this exact same quarter last year, they had over $30 million in that income. And the craziest part? Management just called it a one-time charge, paid it, and filed 0 appeals. Which begs the question, how do you handle a $60 million gut punch from regulators? Well, to signal confidence, Tiger Broker's board immediately authorized a $50 million share repurchase program that runs all the way through June 2027. They're essentially telling the market, look, we accept the penalty, we're winding down the mainland stuff, but hey, our balance sheet is still totally strong enough to buy back our own stock. And that brings us to our first big anchor takeaway. Tiger Brokers is growing incredibly fast, yes, but China just made their exit strategy extremely official. The pivot to Singapore and Hong Kong, that's not a side project anymore. It is quite literally their entire long-term play. The offshore pivot is the whole game now. All right, let's shift gears from a defensive, forced pivot to a highly confident, aggressive internal bet. Section 2, Shopify's $3 billion bet. Get a load of this. Shopify just filed an 8K announcing their board approved an additional $3 billion in share repurchase authority. When you stack that on top of what they were already doing, it brings their total authorized buyback firepower to a massive $5 billion. As of early June, they'd already deployed about $1.45 billion of that. That is an absolute mountain of dry powder being pointed squarely at their own stock. So the crucial point here is context, right? Shopify isn't just that place where your buddy set up a website to sell custom t-shirts. In 2025, they processed over $300 billion in gross merchandise volume. That's the total value of everything sold across their platform. They've been deliberately expanding way past basic e-commerce, pushing deep into payments, merchant capital, and financial services. They've quietly become one of the absolute biggest fintech infrastructure providers on the internet. Now, when explaining this $5 billion authorization, their CFO, Jeff Hoffmeister, mentioned their consistent cash flow and durable balance sheet. But listen closely to the back half of his quote. He said they want the flexibility to build for merchants and return capital to shareholders, especially when markets get choppy. And this right here brilliantly illustrates how we decode corporate filings. That little phrase, especially when markets get choppy, is doing so much heavy lifting. Shopify isn't spending $5 billion buying back their stock because they ran out of things to build. They are doing it because the stock hit a rough patch. Management is looking at their bank account, looking at their stock price, and loudly declaring that the market is currently mispricing their business.
Which lands us on our second takeaway. A $5 billion buyback isn't just about returning capital. It is a giant, flashing billboard. When a CFO casually cites market volatility to justify a buyback of this magnitude, it means one thing. They think the stock is on sale, and they are buying the dip. Let's move on and see how this builds into our final story for today, which is a brutally aggressive, offensive move in the corporate talent wars. Nubank stealing Visa's talent. First things first, we really need to respect the sheer scale of Nubank today. We're talking over 135 million customers across Brazil, Mexico, and Colombia. In Q1, they blasted past $5 billion in revenue for the very first time. And they're not just torching venture capital to grow. They pulled in an $871 million net income with a phenomenal 29% return on equity. Down in Mexico, they already hit break-even and became the country's third largest financial institution by customer count. Listen, the days of treating Nubank like some scrappy startup are long gone. This is a highly profitable, heavyweight global bank. And a heavyweight global bank needs heavy-hitting institutional credibility. Nubank just announced that Guilherme Lago, the outgoing CFO who basically built their financial infrastructure from the absolute ground up, is transitioning out. And who did they tap to replace him? They hired Rob Livingston. Now, Livingston comes straight over from Visa, where he was literally the CFO for North America. That is Visa's single largest business unit. The guy brings over 30 years of top-tier experience across North America, Europe, and Asia. Pulling an executive of Livingston's caliber out of one of the most powerful payment networks on Earth, that signals Nubank is playing a totally different game now. And that's our third takeaway. You don't recruit a guy from Visa's biggest seat just to maintain the status quo. You recruit that specific, international, institutional profile to manage what is coming next. Landing a Visa CFO isn't just a simple succession story, it's a massive declaration of intent. Okay, we have covered a lot of ground today, so let's bring it all together for the big fintech takeaway and run it through our framework. Just to recap concisely, Beijing just gave Tiger Brokers a very expensive reminder that hypergrowth without the right licenses comes with a massive price tag, forcing a total pivot offshore. Over in e-commerce land, Shopify's board used a $5 billion buyback to quietly whisper to the market that their stock is a massive bargain. And finally, Nubank just upgraded its entire finance function by poaching one of the most credentialed operators in global payments, making it crystal clear they are gearing up for global scale. So I'm going to leave you with this final thought. As the very rules of financial technology are constantly being rewritten right in front of our eyes, who do you think is making the smartest bet? Is it the defensive regulatory pivot, the multi-billion-dollar buyback, or the ultra-aggressive executive poach? Let that simmer. And just a quick reminder, this explainer is strictly for information and entertainment purposes, not investment advice. Though you can probably assume I own at least one fintech hoodie and way too many debit cards. Keep reading between those lines, keep finding the signal in the noise, and I will see you in the next explainer.